Hey everyone, welcome. It's good to see you guys. It's been a few days and good to see you guys again. Hope you had a great weekend. Uh, Markets have been kind of interesting, right? So let's go over real quick the overall markets. And hi, Lise, good to see you. And what we saw last week, right? We had those gap ups, one, two, three gap ups, fourth slightly move upwards, maybe gap up if you want to call it that, then chop sideways. This fit perfectly into that pattern that I was telling you, sell into strength, one of the four signs of it might be time to exit. So uh, the third one was at least two gap up days in a row. So if we won two, you would have exited this day. And then you can see that the next 2 days didn't really go really all that much higher. And then we pulled back to the EMA 8. So that would have been a good exit. Now that we pulled back to the EMA 8 and we basically came right to it or touched it for the last 3 days, well, this is a mostly sideways trading. It is continuously moving on a high range, so basically high realized volatility, sideways chop across the EMA 8. So this market is still really incredibly strong. It does not want to go down. It is absorbing basically everything that can be thrown at it, and it's just shrugging it all off. So last week we had Powell come in and basically throw a little bit of cold water on this idea that we might get another rate cut in December. You can see that before he said anything, we were well in the 90s. I think at 1.98% priced in that there was going to be another rate cut in December. And right here, you can see exactly 1 week ago was 94.4. And today we're sitting at 68. So it did go up. We did see on Friday, we did see it at 63%. So we did go up a little bit, but 94% all the way down to 60 something percent. That is quite a big change in the expectations in the market. What is really interesting is that you didn't really see the market react to that. Basically, we just saw the S&P kind of do this, or it really didn't do all that much. For a 30% change in the probability that we might get another rate cut, and all we do is pull back to the EMA 8, that's pretty incredible. That's really strong. So that's also telling us that the market isn't super hyper focused on rate cuts anymore. It's got its eyes on other things, whether it should or not. That's what is happening. Where we did see a little bit of a reaction is in the bond markets. And you can see that gap down and then traded a little bit lower than we gap down again today. So the bond markets are not liking that we might not get another rate cut. And so what this is showing us is that yields went up. When prices go down, yields go up. So if I look at the 10-year yield, we see that popping up. Now, it's not super high or significantly up yet. It is just kind of coming back into this area where we chopped around it in October. But it is pretty significant that there we have this move. So the bond market definitely reacted. The stock market has not yet. And so what that's showing me is that normally the stock market would take its guidance from the bond market. The bond market is very sophisticated. There is almost exclusively dominated, or not just dominated, but almost exclusively traded by institutional investors, and they know what they're doing. So we don't have this mix up between retail and institutional investors. So generally, the direction that the bond market moves is the direction that the stock market is going to move. And of course, there is periods of time where they decouple and decorrelate for a little while. And this is certainly one of them right now. So what that tells me is that the stock market is not taking its normal cues. It's not looking at the things that it normally looks at. Whenever that happens, then it could start to engage in irrational behavior. In this case, irrational exuberance. very high. And it's been going higher and higher all year, except for that dip in April. And it's been doing it for a long time, actually, well beyond just this year. It's been doing it for a couple of years now. So that has me very cautious. So unfortunately, that still has me at a one slightly bullish in the portfolio, in my portfolios. I'm just not willing to go super bullish right now. Yes, we're at all-time highs. This market just seems incredibly strong, but I can't see the value in what it's chasing. Basically, the only things that I can see it really looking at is SMH, so semiconductors, the Mag 7, and it's still incredibly high. We have AI related uh, 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 companies. We have energy or nuclear related companies simply because it's all the same theme of AI and chips and tech. So that's not a lot of diversification, and that puts us on shaky ground. Just probably unsustainable of this move to just continuously go higher without some sort of significant pullback. We've been talking about the MA50, where over here we sort of tagged it, if we want to call it that, but we haven't had a real solid test of the MA50. And in this case, as high as we've gone right now, I'd probably, and as close to MA50 is to the current price, I would probably be looking for something bigger, a bigger move. And another reason why I say that is these moving averages are getting close. Over here at the beginning, the moving averages have large separation. The EMA 8 has some distance from the EMA 20, which has a significant distance from the MA 50. Over here, or I guess right before this pullback to the EMA 20, there's some distance between the EMA 8 and EMA 20, and then there's some distance to the MA 50. Not nearly as much as over here, but there's still some distance right here. And then over here, we came and touched or came close to touching the MA50. And you can see just before the EMA 8 turned down, yeah, there's still a similar amount of distance between that EMA 20 and that MA50 as there was over here. And over here, we're just getting a little close. It's getting closer. It's not as far as this distance right here. So over here, but we can quantify it. We don't have to just qualitatively talk about this. At EMA 20, so about 2% away. And over here, as of this moment, we're about 1.7 or it's 1.75% away. So this gap seems to be narrowing, and that is topping type of behavior. That is something that we see over here, right? And at some point, the moving averages are in the same location. They're crossing each other, maybe back and forth, depending on whether or not there's a period of consolidation. It's just a early sign that, oh, okay. Thank you. Right, sorry, that's Miso. I'm working from home today, so I've got the cats. Can you move, please? Move so I can see what I'm doing, please. Okay, come on, thank you. And so we have some distance there, and or that distance is closing there, and so that is also making me a little bit more cautious. There are some other signs. Okay, now we're stepping all over the keyboard. Come on, thank you. And now, so we'll take a look at those. So let me see what you guys are saying first. Hey, Lise. Hey, Kay. Hey, Chodori. And Spider Monkey. Thank you. Thank you. Yep. And C Fazio and Dan. Great to see you guys. Okay. So, and if you're on the Gamma port a little bit earlier, Chris Pulver was talking to us about the market breadth and how narrow the market breadth is right now, and how basically the focus of the market really is the Mag 7s and the AI related stocks. So if we go over here to bar chart, we start taking a look at the market performance tab, and we can see the market breadth. And I'm and we can see right here that basically IT or tech is the only one that is comfortably performing. And healthcare is starting to come up, which is it. So that's more defensive. So IT has been up, or tech has been up for a while, and healthcare is starting to come up. So that is a warning signal that, hey, we're starting to move into defensive sectors. All these sectors are struggling on the 50-day moving average. There's more stocks below their 50-day moving average than above their 50-day moving average. Staples is just tanked, but that could be bottoming. Look how low these numbers are. And so if Staples starts to come up and healthcare starts to come up, those are very defensive sectors. And where are we rotating money out of? Well, so far it's been the other sectors and not so much the tech, but at some point that's going to bleed out and go into and start money is going to bleed out from there and go to other sectors as well. So everything is in this kind of flux. We're starting to get this feel that we're getting a little bit toppy. Doesn't mean that we won't go higher before we go down, but everything's a little toppy. And the SPX, there is a lot of gamma exposure and a lot of bets that we will hit 7,000. Now, at this point in time, we have less than 2 months left in the year. We have a lot of holidays coming up. We have the Thanksgiving holiday, we have the winter holidays, and activity generally is going to slow down during those time periods. So there's not a lot of time left for the market to make a really large run. And there is a lot of exposure at 7,000. So we could hit 7,000 and then we'll have to see from there. Does it start to run up, or does it have do we have a pullback, and how significant does that pullback become? So you're going to start seeing me focus more on more cautious types of trades, less trades on just pure calls to the upside. We're going to look for more neutral type of trades and things that have limited risk to the downside. So in case we get a movement downwards, it doesn't devastate us, or we can still profit. So right now I am still slightly bullish though, so don't interpret that as bearishness. I do, or for now, we have to just follow what the price action is, and price action is still bullish. It's just that we're seeing signs that it could be topping. Hey, Peter, good to see you. So that's what I'm seeing for the market right now. The trades that are doing well for me, as I mentioned on the Gamma report, are the ones that are mostly neutral. But then I want protection to the downside. So if you're in the weekend trading club, you're familiar with this concept. This is something that I've been emphasizing lately, where basically if it goes down, we make money. If it stays exactly where we are, we make money, usually about the same amount of money as if it goes down. If it goes higher, we make more money up to a certain extent. If it crosses a certain point, then we head back down towards break even. And then if it goes just runs way, way, way higher, then we start to lose money. And then we would just close out our trade. But right now, I'd rather have risk to the upside than risk to the downside, meaning that, hey, I can get paid more if it does go up. But if it goes too far up, then I start to lose money. But it doesn't matter if it just chops sideways or goes down. And maybe I'll give you some examples of that, of some of these trades that I've done. So a good example would be Citigroup. You know what? Let's do something else in the finance space. A lot of the financial stocks are just chopping sideways right now. They are exhibiting this kind of bullish pattern, but they are chopping sideways. And actually, this is exactly what I was talking about in the S&P 500, where the gap between the EMA 20 and the MA50 shrinks, and these pull back and they start chopping across each other. And so that is either a consolidation sideways before it continues moving upwards, or it could be a top before it starts coming down. We don't know for sure yet. All I know is that this is an area, this is going to be a local top right here. And the S&P looks like that. It looks like it's developing into this. So I don't want to be hyper bullish right now. I don't want to be even normal bullish. I just want to be just a baby amount of bullish until we see what plays out. A lot of these finance stocks or bank stocks are chopping sideways. I did notice BK earlier chopping sideways. I noticed Schwab doing the same thing, chopping sideways after a run up. And we also saw, and you can see Schwab has even pulled its MA9 or 90 into the mix of moving averages as well. So it's really chopping sideways, consolidating sideways. Goldman, I saw the same thing. So you can see all the moving averages have converged and now it's just chopping sideways. So if I wanted to trade one of these, I would want to take advantage of that sideways movement, but I also want to limit my risk because if it breaks out of that consolidation, it could start to move fairly quickly and then I could lose some money. So either if I iron condor it and it breaks out of my range, then I lose money. If I do a vertical, then I only have risk to one side. And so in the case of, for example, Goldman or basically all the finance stocks that we just looked at, overall it's still in a bullish trend. Or we could argue that some of them have definitively entered into a sideways consolidation trend. But even so, it's more likely that it's going to break out to the direction it was moving while it was consolidating. Actually, it's roughly 70%. So if I wanted to, if I believed that it was going to go up, or it's more likely that it's going to go up than it is to go down, then I would want to eliminate any risk to the upside, meaning that no matter how far it goes up, I still make money. But if it goes down to a certain point, in other words, I am wrong that it's more likely for it to go up than down, then that's when I lose money. That's how you always want to structure your trades. If I'm wrong, I lose a little bit of money, and if I'm right, I make money. And hopefully I make more money than if I would have lost if I was wrong. And that's how you set up your edges. So one way to do this is you can do a unbalanced iron condor, or you could do a broken wing butterfly. So let's take a look on, might as well do Goldman. I'm on here. And I might cut this session short today because I got back late last night and I've been on several, well, not several, but I've been on a couple shows today. And I've been talking, although I didn't talk that much on Gamma Report. I was just mostly listening to the other guys. So if we go over to option strat and we build, for example, an iron condor, and we say, hey, I think it'll stay between 820 and 740. Okay, so we can do that. We do Goldman. We say, so I said 740 and 820. And you can see that's a pretty broad range. I'm not going to get paid very much for this. All right. So my reward risk is about, okay, it's not terrible, actually. It's actually not too bad for out to November, just November 14th. So my max profit is 196 and my max loss is 304. So about 60-ish%, 64%. Okay. Not bad, especially for a couple of weeks. So I could do that. But if Goldman decides to break out of its range, then I lose money. So, and we determined that there's a reasonable chance that it could break to the upside. So how do I change this? So I would want zero risk to the upside. And so what I can start doing is playing around with the structure of that iron condor, and doesn't look like I'm going to be able to do it. Okay. But we could play around like, oh, those are minimum. So it doesn't look like I can do it. But what you see is that when I move this side went higher, closer to that zero line. So at some point in time, sometimes, or oftentimes, I should say, we can eliminate risk to the upside. It'll look like it'll look just like this, except this whole area will be above the zero line as well. Maybe I can do it on the monthly. Yeah, okay. So there you get an idea of it. So to the upside, at some point I do make less money than I would have if it stayed over here, but I still make money. And that's pretty good. Now, on this particular way that we did it, the reward risk is terrible because if we're wrong to the downside, we lose 10 times as much money as we could have won over here if it just stayed within this sideways range. And then over up here, we only make a fifth of it, so about 2%. So that's not super ideal. And December is probably better. Yeah, see, if we buy ourselves more time or if we give ourselves more time, we're actually selling time here. So we can make better, a slightly better reward risk ratio. Okay, so this is actually twice as good reward risk ratio. But then you have to wait a really long time. You have to wait a month and a half on this one. So let's see if we could try to accomplish something similar, but we'll try to do it with a long call butterfly. And instead of having this flat region before the minimum guaranteed to the upside, we'll just have a triangle before the minimum guaranteed to the upside. And this is actually probably going to make it much easier. So remember our range was 740 to, I believe, 810, 16, 820, I guess. We'll do 820. So we'll just keep that in mind. So on the downside, our break even, we wanted it to be around 740 for a comparable trade. And we could just do that. And it's the break even is not or near 740. So if I wanted to do this and make it closer to 740, I can do that. And we just create this broken wing butterfly with break even around 740. Now this one's really expensive because I moved that really far out, but we can do better. We can do maybe something like this. And here on that high end, if it goes higher, but what if I want to cover the current region? Well, yeah, so never mind. If I go up from here, I make 26%. If I stay where we are, I make 26%. But then if we go down, I have the potential of 67%. So that's not looking super great to me. And also, we're not expecting it to come down here. We're expecting it to chop sideways in this range. And so I actually probably want to use that MA50 as my lower level, which is 772, or we could call it 770 to be a little bit more conservative. And so we'll just pull this up to 770 or maybe even 775. And then we can begin to create something that could be really interesting. And so what we see is that if it stays right at 775, we now have almost a 200% profit potential. So 600 times 3, or so I'm sorry, the max profit is double the size of the max loss. And then if we go up here, we still make 45%, which is really good. So if it goes beyond our range, we still make 45%. And basically, if Goldman breaks out and goes higher, no problem. I'm guaranteed to make at least 45%. If it only goes up a little bit or stays exactly where it is, then I can make a whole bunch of money. I can make it up to 191%. And then only if it falls down below 761.88. So let's see where that is. Okay, which is significantly below the MA50, more than double the distance from where we currently are to the MA50, then we can still, at the very least, break even. And so that's a pretty solid trade. Right now, in the current environment that we're in, the choppy stocks are probably going to remain choppy. I wouldn't be doing this on healthcare or staples because those are the sectors that we saw where staples was overdone and maybe due for a bounce, and healthcare was on its way up, so it's already moving. And so we would avoid those, but we were doing it in the financial sector. So that's perfectly fine. And then if it just keeps on chopping sideways, we make a whole bunch of money. And if it goes higher, we make really good money still, 45% over out to December. Let's try November 14th. Okay. So yeah, even if we kept the exact same strikes, we would make 150% if it stayed where it is, and we'd make 28% over 2 weeks. That's not bad. That's really good income. Right? That's really good return on an income trade. Any questions about that? Let's see. BAC seems like it's breaking out and others may follow. Let's see. Yeah, Dan, thank you for that. Yeah, so I modified it to November. Let's look at BAC. Yeah, BAC is definitely moving. Looks like I put on a I put on a trade or consider putting on a trade on this breakout. Okay. Yeah, so BAC is definitely moving. It is ahead of all those financial stocks that I showed you guys. So it's definitely exhibiting relative strength. XLF itself, not so much. It's chopping, showing it kind of weak, but it's chopping. So BAC is definitely a sector leader. And will others follow suit? Maybe. But if they do, that's just fine. Right? We're perfectly safe to the upside, which is exactly why we designed it this way. Okay. Any questions about that? Anything you want me to go over? Otherwise, I'll end it there. I haven't had lunch or I haven't had food today, and I'm getting kind of tired. But I'm happy to answer any of your questions or go over another topic. Okay, I'm not really seeing anyone type in. So just so you guys know, just have a heads up, a publisher is considering having me move the time of these. So obviously it wouldn't be a post-market review anymore. We would move it earlier and then or merge with the closing playbook with Graham and Nate. And that way we can actually get some trades in, which could be kind of exciting in the last hour to half hour of the trading session. So I might join the closing playbook instead of doing the post-market review, and you could actually get some trades in there. The trade-off would be a little bit less education because markets are open, we're looking at trades. I would still do an educational component to it, but I might not be going deep dives like I have been in a post-market review. Let's see. How important is the dispersion trade towards index volatility. I'm not really sure exactly what you mean by dispersion trade, but volatility will not, if you're holding it towards expiration, it's not going to affect it too much because this is a butterfly. We're all trading all the same date. So you can see that if I move this, if volatility goes up, it makes it harder for me to make money, or in other words, I have to wait longer time in order to make money. But by the time expiration hits, it's still the exact same, exact same graph. Okay. And then if volatility goes down, then it makes it easier for me to make money. You can see it starts going towards that shape a lot sooner. Okay. So volatility will affect it during the life of the trade, but if we're holding to expiration or close to expiration, then it won't matter much to us. And most of these, and generally, if I'm going to set it up this way, where the peak is exactly where we are or very close to where we currently are, basically I'm counting on chop sideways, then vast number of most of the trades we would hold to the last day anyways. What would be the stop on a trade like this? Okay, so that's a good question. So basically, look at this. If we do volatility, let me reset this. Okay, so over here, what you'll notice is that the way that we set up this Goldman one is that if it falls, I make more money. Okay, so if it goes up, I just make the same amount of money. But during the life of the trade, before the last day, I make more money as the price goes up. So if the price goes up, then I just hang on to it. And I'm just going to expect that I'm probably going to make that minimum right here, that 28%. So if I don't want to hold it into the expiration, then I could just say, hey, if it hits 28 or 30%, I'm just going to close it out. That's perfectly fine. But you'll notice that if it hangs out in this region, though, it is advantageous for us to probably wait till the last day, because you see how as it's trying to form up into this triangle, there's a certain region over here where if I hold to expiration, I'll only get 28%, but a few hours before expiration, I can make double that. Okay? And then if we're down here, then I make a significantly more than triple that. And then if we pin it right at the very end, and if we see low volatility that day and prices aren't really moving and we're just around that 775 area, then we might consider holding it all the way to expiration, or just before the market closes, we might close it out. And then we could capture close to 150%. So the only time we would quote unquote try to stop out or consider stopping out is, hey, if we start aggressively moving downwards, okay, and we hit 775 tomorrow instead of sometime next week, and then, oh, you could say, well, that's the beautiful thing about these butterflies, is that the T0 lines are really forgiving. If tomorrow, some point in time tomorrow, just say in the middle of the day, we go back down to 775, I'm only losing 7%. So the reward risk ratios on the trade are really, 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 really good. And so I wouldn't consider stopping out unless this aggressively moves past 775. Like if on Tuesday we're already at 770 or 765, then I would take the loss. And then as each day passes, the further below 775 I am, the more at risk it is. But if I'm between 765, or sorry, 762 and a half and 775, technically I can still make some profit, but the risk is big because on the last day we can expect volatility because of options expiration. So I probably wouldn't want to wait around for that. If I can get out at break even or just down a few percent, I'll get out rather than hope for a bounce. Okay. Good question. Mm, good to see you too, Maria. I think GS has gamma exposure to the upside. Yeah, great. Perfect. Right, well, we have zero risk to the upside. We'll guarantee to make money to the upside. That is a terrible idea. I take that Nate and Graham need some help, but if you have freight from oh, I thought you were talking about the trade. You think that me going over to the closing report, the closing is a terrible idea. Oh, well, we're still talking about it. It's not set in stone, so I'll see. I'll try to find out exactly what they're trying to accomplish. There's a trend towards shorting index vol and going long single stock vol, which ended recently after the majority of Mag 7 reported. Yeah, that was yeah, that would have been a good trade around earnings season. Yeah, that that if index volatility is no longer suppressed and the correlation between individual stocks starts increasing again, does that hurt this particular setup? No. So um, the correlation between stocks, right? So the individual stocks, basically what you're saying is that the the all stocks are moving the same way. Okay. And so actually uh any movement is they're not dampening each other anymore. And so you would get a heightened volatility in the indices. But if we're doing these on individual stocks, that doesn't really matter to us. And again, if we increase, even if it did, if it increases volatility, it just means I have to hold on to my trade longer, right? It doesn't change the ranges in which I consider, well, it doesn't change my profit into the last day, into the close. Right? It doesn't change my profit at all in the last couple hours to expiration. It doesn't change my profit, and it won't figure into my stop loss either, and unless it's really volatile, because then if I'm at 770 and the next day I could be at 750, it's that volatile, then yeah, then we would close a little bit easier, but not a little bit easier, sorry, a little bit earlier. But other than that, it wouldn't affect the trade at all. Good question. You like the aftermarket analysis? Okay, I'll take that into feedback, and I'll take that to publisher, and just, well, let me find out why they even had the thought, and we'll figure it out. I think that it might be because they haven't really been driving traffic to the post market, and right now we have 30 people watching, and it's not getting a wide viewership. And so they think they might get better viewership on the closing bell. I don't know. I have to ask them and see what's going on. Okay. Yeah, you're welcome, Chidori. Yeah. Any other questions? Anything else I can answer? Okay. All right. Sorry for I am a little tired, so my speech was a little more jumbled and probably a little more monotone than usual. So I apologize for that. Uh, definitely miss having just you, but whatever. Okay. All right. Thanks. And maybe, I don't, just because I'm on a different show doesn't mean I have to end this one. It's not getting much support, and basically wouldn't get support from the publisher either if that was the case, I guess. So, but that's okay. All right. So I'll see you guys tomorrow. I'm going to get some rest because I keep jumbling and slurring my words. So, have a great rest of your day, and I'll see you guys tomorrow. All right. Bye, guys. See you later.